Happy New Year, guys! Happy New Year! Happy New Year. I wanted to start this year by learning something hard, and one hard thing that I was ignoring from the past year was learning about options. So this year I said, no more, let's start learning about it. So I learned about selling put options and selling covered calls. So this is the outview of what I've executed so far. I chose these three stocks to try these two strategies, which is selling a covered call, selling put options. This is the money that would be invested in these three stocks, and so the total would be 4,000 US dollars. And I gained 17% on it immediately, and I will tell you how. So let's begin by selling put options. But before that, understand the reason, understand the benefit of it. Before even we begin, you need to ask me and yourself that why does this even matter? Why can't I just normally buy and sell stocks? Why even bother with this complex terminology, options, contract date, strike price? Too much. I will tell you why. First of all, the terminology put and long. Okay, put means you are betting on the stock to go down. In long, you are betting on the stock to go up. Okay, or put can also be called short. You are shorting the stock. Some people say. So let's open Nvidia for you. So you are like, I will only buy Nvidia at 170. 170 is this range, the support structure. Now think of yourself as a very cautious investor. Nvidia is, let's say, 200 to this day, and you are very cautious. You say this is overpriced. I only buy Nvidia at supports. So this is the support level, and you say I will only be comfortable buying Nvidia at $170 per stock. So what if the stock is 200 and you think it will take 4 months for Nvidia to reach 170? So for 4 months, your money will sit idle. You will wait when it will hit 170, and you won't get paid for it, right? But in options, when you sell puts, means when it is 200, you expect it to go down to 170, means you are betting on it to go down, means you are shorting the stock, as mentioned here, or selling puts. Okay, so when you expect it to go down, we go into the shorting put territory, and you get paid to buy it at 170. How about that? Right? That's exciting. So that term is called selling a put option, which I did here in Richtech Robotics stock. But it's not that simple. You cannot be given all the berries in the garden. You have to take some thorns. So the catch is that it has an expiry date. So in this case, I expect Richtech Robotics to go down to $3 or below on 30 January. So this particular date, this vertical line becomes my expiry date. Now, when I sell a put option, I give a commitment to my broker to buy 100 stocks of Richtech Robotics on the expiry day, that is 30 Jan, if the price is lower than $3 or equal to $3. Okay. Now, on 30 Jan, the price can be $3 or it can be $2. But still, I will have to buy it at $3 100 stocks. Means on 30 Jan, if the price is $2, I will buy it at 3, which will be my capital will be 300, and I will be in a loss of $100 because I bought it at 3, it is at 2, and I have 100 stocks, right? Take some time, process it. But the benefit of it is that if the price goes above $3, when it's 30 Jan, then I don't obey this commitment I gave, because I only gave the commitment to buy it at 3 or lower than 3 on the expiry day. But if it's higher than that price, then my commitment is not valid. But I get paid during this time to give this commitment, which is here. So in Richtech Robotics case, I got paid $34, which is more than 10% of the capital. Similarly, in UiPath's case, I gave a commitment to buy the stock at 16 strike price at May 15 expiry, and I got paid $192 premium, which is more than 10%. Okay, let me show you Path. Now, Path is a lovely stock. I know about its technology, its earnings, and everything is growing. They are improving the margin, blah blah. I have done the research about behind it. So I sell the put option with the expiry date of 15 May 2026 with the commitment that on this day, if the price is lower than 16 or 16, then I buy 100 stocks of Path. Personally, and don't take my word for it, I think the price will reach around 21 on the day of expiry. So I think I won't have to exercise the commitment I gave, so I don't have to buy 100 stocks of it. But still, I got paid $192 just to wait for it. Now there will be two scenarios. In one scenario, the price will go above this $16 range. So then I just keep my 192 and do nothing. My contract will expire without me having to do anything. Second scenario, the price will be somewhere near this support. Let me extend the support. Okay, so it will be $12, $12.76 somewhere. But still, I will have to buy it at $16. Means I will be in a loss of $400. But really, I will be only in a loss of $200 because I got paid around $200 just to wait for it. So we also have to factor that in. So I'm not buying it at 16, I'm buying it at somewhere 14 because I got to pay $200 more just to wait. So you have to factor in the premium collected in the price. Okay. But I did sell two options only considering that the price is going up. So I won't be assigned 100 stocks. So I opened TQQQ, which is this one of the very famous US ETF. Now looking at the structure, we identify this is the support, previous resistance turned support, and now it is very highly possible that the price will come back to 43 range to take the support. So being cautious, being conservative, we don't want to buy it at 52 range. We want to wait for it to touch the 45, 43 range. Okay. But I also want to get paid while I wait. So I go to triple Q options. Then I go to put. First, let's go back and see how much time it will take. So I use this date range tool to forecast how much time it can take. So we'll go to around number 150 days. Let's see if we have an expiry date of 150 days here. No, we don't. We have an expiry date of 166 days. So let's check that. So now we look at the strike price we anticipated to go to, which is 43 or 45. So on the left side, these are the strike prices. Voila, here. $45 strike price, and we are, as we are selling a put, so we see here that the bidding price is $4. Means for each stock, $45 stock, you get paid a premium of $4, which is almost 10% to return. So if I click on this, on the right side it shows me estimated premium is 400 USD. Means if I give a commitment to my broker that when the expiry date comes, which is the expiry date? Yeah, June 18th. So basically, here I'm giving the commitment to my broker that on the expiry date, June 18th, if the price of triple Q is 45 or less than 45, I will buy 100 stocks of triple Q, which will be the capital of $4,500. So in return, the broker is giving me, or not really the broker, but someone else is paying me 400 US dollars just to give that commitment or just to wait. So I sold puts worth $1,900 and I got a premium of something like $226, which is more than 10% of the capital. Now coming to the second case, which is selling covered calls. So I told you that in both of the stocks, UiPath and Richtech Robotics, I anticipated to be going up. So I won't be assigned the 100 stocks. That's my assumption or hope. But in the case where I got assigned, or another case, let's look at Novo Nordisk, where the price is already at the support structure and you anticipate it to be going up because it's already on the support, it's breaking the resistance. In that case, you buy 100 stocks of it and then we sell covered call options, which I did already in the case of Rivian. See here, which means I already bought 100 stocks of it. I'm not committing to buy, I already bought. So the price of each stock was 20.86, so I bought 100 of it, which makes it my capital 2086 USD. And I anticipate that by the time it is September 18th next year, this year 2026, the price will go from 20 to 22 because I'm anticipating it to go up, right? So when it goes to 22, I give a commitment to sell my 100 stocks. So I bought it at 20.86. I give a commitment to sell it at $22. Now what's the benefit in that? I got paid a premium of 455 US dollars. I got paid just to wait for the price to hit $22. Now, when the price will hit $22 or more in on September 18th, even if it's 26.30, I will have to sell it at 22, which means that my capital will increase from 2086 because I bought the stocks at 20.86 to 2200 as the price of stock will be 22. So I will get a return of $114 plus the premium I collected 569 US dollars. So following the two scenarios, if the price goes up beyond 22 on the expiry date, then uh, I'm in a little disadvantage because I will have to sell it at 22 no matter what. So even if it's 30, I sell it at 22. But on the other side, if the price is below my strike price, that's 22 on the day of expiry, I'm not obliged to sell. So I get to keep the premium plus I keep my stocks, and then I can repeat the same covered call for some another expiry date. So let's say on September 18th, if the price of the Rivian stock is $20, so I don't sell my stock, I get to keep the premium, and then I think in 2027 January the stock will go to 24. So I again sell the covered call for that date and collect some more premium, and I keep my stock as it is. So I'm in a loop of getting premiums while I wait for the desired selling price. That's that.